And hello, my colleagues in Finance 545 Capital Markets. I just wanted to create this video from chapter one just to give you an introduction. As you can see here, it says introduction on something I lived through in 2007 and 2008. And that was the crash of the global financial markets. And I just wanted to create a little video to talk about that. So you can kind of see what they say here in your textbook. In August 2007, financial markets began to seize up, and over the next 2 years, the world economy experienced a global financial crisis that was the most severe since the Great Depression years of the 1930s. Now, let me just make a point here. It looks like every 10 years, we tend to have a financial crisis. And if you look at the history of financial crisis, they seem to come every 10 years. So we're 10 years now, more than 10 years into that past one. So only time will tell what's going to happen, right? So I don't know if any of you people remember it. It was like 13 years ago, 12 years ago. You might have been too young, but your parents will know about it. Housing prices plummeted, the stock market crashed, unemployment skyrocketed, and both businesses and households found they couldn't get credit. Now, what I did when these things happen, I take advantage of them. And when the stock market drops, there's an old saying, buy low, sell high. So I took advantage and I bought in, and I did very well in the aftermath of this stock market crashing. So, that's the way that went. And you have to think about this long term, okay? So not only did the Central Bank of the United States, which is the Federal Reserve, of course, and this is an important. We'll learn more about the Federal Reserve. I have a lot of articles up on the blackboard on the Federal Reserve. Respond by sharply lowering interest rates, and the reason they do that is so people can borrow and get the economy back on track, right? And intervening in credit markets to provide them with massive amounts of liquidity, meaning money. But the federal government also entered into the act with a $700 billion bailout of weakened financial institutions and huge fiscal stimulus packages totaling over $1 trillion. It was a really, really rough time back then. But as you read on, right? But as you read on here, but even 7 years into the crisis, unemployment was still at 6%. So this was about like 2015, and it has since recovered. But now we have this pandemic, and only God knows where this will take us. Okay. So back then, a lot of people lost their homes. A lot of people were like what was called flipping houses. I don't know if you're familiar with that, but a lot of people did house flipping, and a lot of the people got caught with their pants down. People would buy houses and then fix them up and then try to sell them. So, many governments throughout the world were also in tatters, it says here, right? It wasn't just the United States. So, the global financial crisis and its aftermath demonstrate the importance of banks and financial systems to economic well being, as well as the major role of money in the economy. So, just as an introduction, part one of this book provides an introduction to the study of money, banking, and financial markets. All right. Chapter one outlines a roadmap of the book and discusses why it is so worthwhile to study money, banking, and financial markets. Chapter two provides a general overview of the financial system, and then chapter three explains what money is and how it is measured. Okay. So then the first couple of chapters in this book are important, all right? And we're going to skip around, by the way. I expect that someone being graduate students, you would do a lot of reading on your own, okay? All right, now I don't know why that didn't. Okay, so So let's do a little preview here of financial markets. All right, so you have just heard on the evening news that the Federal Reserve, right, which is our central bank, is raising the Fed funds rate, okay, by 1/2 percentage point. What effect might this have on the interest rate of an automobile loan when you finance your purchase of a sleek new sports car? Why don't we look at the Fed funds rate and see what it is?
Federal funds rate. The federal funds rate is the overnight lending interest rate banks charge one another to borrow money. Yes, banks do loan money to each other. Why is that? Well, recall that banks make money by taking in deposits and using those deposits to make loans. Banks cannot lend out all of their deposits because they need some funds on hand to settle transactions with other banks, to give to customers, and also to satisfy the Federal Reserve, which requires by law that banks hold a certain percentage of their deposits as reserves. Prior to 2008, the banks didn't have much incentive to keep excess reserves above and beyond what was required by law, so the banks tried to keep reserve holdings relatively low. Sometimes they even fell too low to meet Fed requirements, so they borrowed reserves from other banks. Borrowing and lending in the federal funds market established an interest rate, or the federal funds rate. The federal funds rate is important because the Fed tries to affect the federal funds rate by conducting something called open market operations, and through this tool, affects credit conditions and the rest of the economy. However, it's important to keep in mind that while the Fed has considerable control over the federal funds rate, there are lots of different interest rates. In theory, these interest rates move together, and they're affected by the interest rate the Fed does influence. In practice, those connections can be looser or tighter, and that will dictate how good a job or how exact a job the Fed does in steering the economy. To learn more about monetary policy and the Federal Reserve, click here, or test your knowledge on the federal funds rate here. Still here? Check out Marginal Revolution University's other popular videos.
So that was a nice little blurb on the Fed funds rate, okay? So what effect might this have on the interest rate of an auto loan when you finance your purchase of a sleek new sports car? Does it mean that a house will be more or less affordable in the future? Will it make it easier or harder for you to get a job next year? This book provides answers to these and other questions by examining how financial markets, such as those for bonds, stocks, and foreign exchange, which we will go over in the future, right, in this course, and financial institutions, banks, insurance companies, mutual funds, and other institutions, okay, work by exploring the role of money in the economy. Financial markets and institutions affect not only your everyday life, but also the flow of trillions of dollars of funds throughout our economy. All right, so anyway, we're going to go through all that, right? So the study of money, banking, and financial markets will reward you with an understanding of many exciting issues. In this chapter, we provide a roadmap of this book by outlining all the issues. So we're going to go through each one of these issues, okay? And there's always some nice learning injectives here, right? I don't know why it doesn't switch all the time. All right, so part 2 of this book is going to focus on financial markets, right? And financial markets are markets in which funds are transferred from people who have a surplus of available funds to people who have a shortage of available funds, okay? So financial markets such as bonds and stock markets are crucial to promoting greater economic efficiency by channeling funds from people who do not have a productive use for them to those who do. Okay, so this is important to understand. Indeed, well-functioning financial markets are a key factor in producing high economic growth, and poorly performing financial markets on one reason why that many countries in the world remain desperately poor. Activities in financial markets also have a direct effect on personal wealth, the behavior of businesses and consumers, and the cyclical performance of the economy. Okay? All right. So what I'm going to do is I'm going to keep these videos short till about somewhere between 10 and 15 minutes, okay? And I'll make like part 1 and part 2, okay? Just so everybody has time to just read them in little snippets, okay? So we'll pick up here on the next video on right here in debt markets and interest rates, okay? Okay. Talk to everybody later.